Okay, welcome everyone. We'll start our second lesson. My name is Anjum Satar and my email address anjum@ukversity.co.uk. Please, if you have any question, drop me email on my email address. And in today's lesson, we'll go through our LO2, which is learning outcome to be able to analyze financial data for an organization in order to inform strategic decision-making processes are the purposes will try to be achieved. So this lesson will discuss about financial data and how we can interpret that data to use for decision making purposes. So before starting our lesson today, will a bit recap what we learned during our previous lesson. So during our last lesson, anything you remember, Daniel?
Yeah, we looked at financial statements, internal financial management, which is the internal process, and then financial accounting, which is the external process.
Excellent, great. And how many types of financial statement we prepare in accounts, if you remember?
Oh, I can't remember.
No problem. We discuss about statement of comprehensive income, which is also known as a profit and loss account. Second statement, we discuss statement of financial position, which is also known as balance sheet, which shows asset, liabilities, and capital, how much is the investment in the business. And third statement, we discuss about statement of cash flow, how much money in and out from the business through operating activity, which is normal our operation, investing activity, if we have a spare cash, we can invest, and financing activity, how much money we borrowed or paid off. So that's what we discussed. Then we discussed statement of change in equity. Equity statement means shareholder statement, how much dividend we paid, how much shares we issue, how much asset being revalued. All these, we discussed in our previous lesson. Plus, we also discuss about merit criteria, creative accounting. We discuss, the creative accounting is not illegal, but the people can understate and overstate. That's why the new standard. But it's again against the ethical side. I know I can hide it. People not aware of the legislation section, but I should tell them truth. I know Facebook is going to be faced the legal proceeding against them, and they know there are the 60% chances that case will be against them because they not follow the Data Protection Act, and it is in the European Court of Justice. So we need to think about, I should show in my financial statement as a contingent liability. If I don't show it, it's fine, but it's ethically wrong. I'm hiding it. So here is the ethical issues more than the legal side. Ethical mean the principle. It's not a rule-based approach. It's a principle-based approach. So more we need to be focused. Today lesson we'll go through our LO2, be able to analyze the financial data, how we can analyze them, analysis of financial data, how we can interpret and we use for the decision making. Comparative analysis mean 2 years we can compare our two companies are in the industry, which we'll go through. Then our merit criteria, we have two as well, M1, M2. So make recommendation based on the analysis. We can make some recommendation. We can assess limitation. Limitation mean my numbers is really good, nice, absolutely fine. But think about 6 weeks ago, there wasn't any lot of information about coronavirus, what will be happen. But now it's totally different. Yes. So if I'll rely on just on the financial statement or the financial ratio, those really good, but were excellent. But now is the problem. We need to look around the environmental factor as well. What is happening in environment? So though we need to make a decision based on. Then 2D1, we need to recommend with the justification methods and the tool, allow business to analyze. We need to look around how the businesses can be and further and different tools they can use. When we discuss about balanced scorecard model as well in one of lessons in other subject, so we can use it here as well in a financial perspective. So we can look around different perspective. So that our discussion will be focused today lesson all, and we have an inductive content what we're supposed to learn. Any question?
No.
Okay. So today lesson keywords, we can say the publish accounts, which we discussed, statement, shareholders, we'll discuss shareholders, different shareholders, managers, and these are called stakeholders. They can make the decision based on the financial analysis. We discuss already statement and provide different information, and we'll go through some limitation, comparative analysis, benchmark. Benchmark is mean the industry average. We can look around what average is normally different consultant recommend or analysts recommend. So ratio analysis, reasons for using ratios, what are the advantages, disadvantages of each of them, which we'll go through. So yesterday we discussed about as well how many types of ratios we have. Do we remember, Daniel? We discussed yesterday 4 types of ratios, yes? Profitability, liquidity, use of resources, and gearing ratio. So these ratios we discussed. So today lesson we'll try to apply them. So financial statement on their own are of a limited use, of course. For example, if you were to identify that business has made the profit for 1 million, what does that tell you about the business? So what will be? If I'll say I have 1 million profit, are you happy to invest? Hello, can you hear me?
Sorry,
Hello?
I had my hello. Sorry, I had my speaker off.
No.
Microphone off. Yeah, it's nice to know that you've made a profit, but as you say there, it doesn't tell you how you've performed against your competitors, whether you're the best option to invest in.
Excellent. So I have a profit, but my profit can be just a credit sales. Sales minus cost of sales are expenses equal to the profit. But it's not telling me my cash position. So if you have a profit, but you don't have a cash, yes?
Yeah.
So it's no point. It's not telling me full story. I can give goods to somebody. Come on, you buy it now, pay in 10 years. People may be really pleased to buy now and pay in 10 years, yes?
Yeah.
My profit will go up, but my cash, end of the day, we need to look around the cash as well. So does the business is success? No, not telling the full story. It might, but not. If any previous year they made the profit 50 million, they are closest to the revival and the profit of 60 million. So it is important that the user of the financial statement can interpret the financial statement to be able to draw out the valid conclusion. So we need to conclude from it. Either we'll go ahead or not. So we can look around the comparison previous year. So always, if I have a 1 year figure, what is telling me 1 year? I'll say 100 million, I'll say 200 million. But I need to compare with the previous years. Then I can say, oh, we perform better, yes? Or we can, maybe we learn about our moving averages. Have we studied in maybe in even in engineering side as well, maths, yes? Mean, mode, yes?
Yep.
Median. So we can use it, yes? What is the mean? What is the mode there? Most, yes? Most of the year, last 5 years. Median, what is the middle point we have, yes? All this we can interpret all. If we have information 3-4 years financial statement, if we have 1 year, it's very difficult. It is important the user of the financial statement can interpret and able to draw the valid conclusion. Yes, valid. Prior year, forecast, competitors, all we need to look around. Previous year, forecast, and competitors figures. So which we'll try to look around some competitors. Users can compare the sales and expenses figures. Asset liability balance, like we discussed in the last lesson as well. Ratio analysis widely used to support this process, yes? Comparison. Don't forget, though, the ratios are calculated using the figures already present in the financial statement. Maybe we not really 100% relies on the ratios. Okay, next we're looking use of financial statement, the user of financial statement. So different user, employees can use it, supplier can use it, Those are the stakeholders. What is meant by stakeholders?
Anybody who has an interest in the business. That can be suppliers, management, shareholders, staff.
Excellent. So anybody who has any interest in business, or their interest will be influenced by our action, whatever we are doing. Like the generation will come after us, even if we pollute environment. So those are also stakeholders, animals and various other stakeholders as well. So we need to protect that. We'll try to protect the interest of everyone. We need a balanced approach. So sometimes it's difficult. Okay, so which we'll go through, and now we'll go through the ratio. Last lesson we discussed 4 types of ratios, and today we'll try to be interpret these ratios for decision making purposes. So ratios, we have 4 types. Those we need to remember. The liquidity. What is meant by liquid? In business, liquid being near to cash. Liquidity ratios, if you have good, it means you have a cash, yes? You have a stock, you can sell it, you can convert into the cash. You have a debtors mean the receivables, and you can give the invoices to somebody and you can get the money maybe 80%, 60%, and they can, like a debt collector, one example. So we can look around. So these are the short-term assets which we can be quickly convert them into cash. So that's called liquid. Then next we have a financial position ratios. Financial positions mean relationship between debt and equity. There are the 2 ratios normally we call non-current liability divided by total equity plus non-current liability, or simply we can say debt divided by equity. So there are 2 formulas which we'll go through. And then interest cover ratios. What is interest? The interest which we supposed to pay, how many times my profit is more than the interest. What do you think? Who is interested in interest cover ratios? What type of stakeholders?
Shareholders.
Yes, shareholders can be, but highly interested by financial institution, because they're supposed to collect the interest, yes, charge the interest on the loan. So if my profit is, I supposed to pay 2,000 finance cost, 2,000 interest, and my profit is 2,000, or my profit is 4,000, yes. If next year my profit dropped, so is a high risk because my profit is twice than the finance cost, yes. It can be easy. If my profit is 10 times more than the finance cost, then is a very less risky. That's meant by it. So which we'll go through. Any question there?
No.
Okay, then the next slide. What about the profitability and use of resources? So under the profitability, we're looking the profit from operation divided by my investment. So my investment can be total equity plus non-current liability. Non-current liability means long term. Normally we borrow the money, long-term liability like a bank loan for buying fixed asset. Fixed asset means building, plant, machinery in accounts. Next, profit from operation we can divide by the total asset. We can look around. Return on equity, how much shares we have, how much profit per share. Gross profit is mean how much cost me, how much we sold it, and divided by the sale value. We can say how many percent. Specific expense, admin divided by revenue. We'll say how much my sales is going towards to meet the admin expenses. Maybe is the 10% of my sales is going towards admin. So I can think about, I can reduce my expense of admin or for admin. So we need to think about. So then next, inventory turnover days. Do we know inventory turnover days? What is meant by?
How long you hold stock for?
Yes, how quickly you convert it, how long you hold it. Yes. So that's, we need to look around. We need to look around in industry. Trade receivable, how many days we are receiving money from debtors, how many days we are paying to suppliers. Inventory days, receivable days minus payable days, that's called working cycle. How long our working cycle, which we are going through. Revenue divided by total asset. These are the different ratios. We don't need to really calculate all. We need to think about what decision we are making, which ratio is more appropriate for us. Okay. To next now, as we discuss these ratios, the financial statement, the main objective of financial statement to help the user to make economic decisions. Yes, that's the key objective. As we discuss at the top as well, the ratios will help. So now we'll go through and we'll conduct the comparative analysis by using these ratios. So I already copied all the slide, what is meant by each ratios. So we can go through separately, yes, what this shows, what is meant by liquidity, what is meant by. So now we'll go through the ratios. I'll send you this handout. I'm just using not a real company now, but we'll use some, and we can use the real as well. So first, we'll go through the question what been asked. So we have two companies in the task, Anika and Papika. We can say company A and company B. Yes. So if we look here, the revenue, because these are the very straightforward figures, so easy to understand. So we have a revenue. One company is 36,000, other is 28,000. What cost them? The things they bought it and sold it is cost them 19,800. So Anika gross profit is 16,200 and Papika is 14,700. So then distribution cost we've been given, admin cost we've been given, both companies. So we can calculate. Can we try? We can pick in a few ratios. So first, we'll go through the profitability ratios. I'll send you, just 1 second, I'll show you a sheet which I'll send you, and basically the template I prepared, so that will help us to, when we'll do our assignment, to address this, we can pick any company and we can go through some figure, and this template we can use. Come on, why not opening? Okay. So can you see? Yes.
Yeah.
So what we can do, let's say we are doing more next and Marks and Spencer. So we can write the next. Yes, we can write the Marks and Spencer. We can write the year, or we can go through the 2 years Marks and Spencer, 2 years next. Or if we want other any company, maybe we can compare 3 companies or 4 companies. Yeah. But one thing we need to be look around. Can I compare Tesco with the Premier or store or various other small stores now, convenience store? Because the Tesco is a big, yes?
Yeah.
I can't really, I supposed to be compared Tesco with Asda.
Like for like.
Because it's a like to like comparison and the same size are quite near to be. So if on FTSE 100 index company will FTSE 500 index, yes? So we need to think about. So it's not a good comparison. So always, we've been given the ratios, all the formulas, and we can calculate and we can copy these figures, and that sheet we can copy into our assignment. Yes.
Yep.
That's that's the way, and we can then underneath we can interpret what is meant by these figures, what's happened this year, that year. So that's easy in a way. So we have this now. So we'll go back to, and it's already calculated. So gross profit margin of both companies. So gross profit times 100 divided by sales. Sales also known as revenue. Sales, revenue, and turnover is the same thing. There is no difference. Different company use different words. Is a terminology. So this is 45% and this is 52%. So if we look the sale there, they have a sales, Papika is less than Anika, yes?
Yeah.
But the profit is more, gross profit.
Percentage, yeah.
So they have 7.2, 7.5%. So when I'll write, I can. Why they have? Because the Anika's cost of sales is more. So Anika need to be focused in the cost of sales. Yes, when they reduce the cost of sales,
The profitability will go up.
They can increase the profit.
Yeah.
Any question here?
No, understand that. Yeah.
Okay, next, operating profit. Operating profit come after minus all other operating expenses. So now, if we look here, the gross profit was the difference between the sale and the cost of sale, the things we bought it, the things we sold it. Then we have some other expenses which we call indirect or overhead expenses. After this, I have only 9% profit. Operating profit, yes?
Yeah.
And I have here is only 11.5% profit. So which one is better now?
Papika.
The Papika is better. So according to the Papika, why Papika? Because if we look here, there's 7.5% was the difference between the gross profit of two. But when we went down to operating profit, the difference is reduced to 2.5. Yes.
Yeah.
So it means the still Papika has operating expensive quite high. Yes.
It must have, yeah, to reduce that margin.
Because that's to reduce the margin. So maybe Papika can focus to reduce their operating expensive. And Anika, of course, is significant, yes. So Anika need to be reviewed as well. The cost of sale they have to review. They have to review the operating expense as well. Because how many percent? If we look the difference between 45 and 9, how many percent is going towards operating expense? We call indirect expense.
36%.
Yes, so 36% is going towards operating expense. So I need to, if we are a manager, we need to manage, we need to look around where we can cut these, yes? Maybe advertising, maybe we are doing very heavy, and maybe we need to review the contract we have with the company. Or we used to be fixed contract, we not anymore fixed contract. So we need to review. Any question there?
No.
So we can pick two ratios from profitability or to each category of ratio to make decisions. Then next we're looking now Anika and Papika, yes? Their balance sheet. So they have plant and machinery which is called long-term asset, yes? Both companies. So Anika is more than Papika. Then the current asset which is most liquid. So they have 7,123 pound worth of, and other is a 2758. So we can look around these, and then we can, if I need to calculate the liquidity ratio, formula is current asset divided by current liability. So that's my current asset 7123, and my current liability, I'll go down and I'll find my current liability. So my current liability is 3876. So what I can do, I can divide them, yes. I can calculate. So yesterday we discussed it need to be approximate 2 to 1, but this is not a hard and fast rule. It can be varied industry to industry. So we can look around these. Now we'll go back to our calculation and we look the liquidity first. So we have gearing. Okay. Asset test. Yes. This is also come under the liquidity ratio. Current asset. Yes.
Yeah.
And minus inventory, because sometimes some inventories won't be liquid. Yes. You can't quickly sell them or get the cash because maybe those are outdated. So if you want to be most liquid, yes, so take out the inventory out of it. That's normally benchmark is 1 to 1 if you take out the inventory figure out of current asset figure. So you will see there, that's my current asset without inventory. That's my current liability. So we said it need to be 1 to 1, but now it's Anika is coming 1.2. It means every £1 worth of liability, they have £1 and 22 pence worth of asset, which is quite, yes, which is a good,
strong position,
financial position, which is good financial position, and it's a most liquid position, yes.
So when we looked at Tesco's yesterday, we was at 0.38. So Tesco's are not very liquid, not in a very good liquid position.
Oh, yes, not very good liquid. There can be one of the reason because Tesco business is more about the perishable goods, yeah.
Yeah, the stock inventory, yeah.
Yes,
so that's come off the current assets.
They're getting normally 90 days or 100 days, yes, credit.
Yeah, yeah.
So that can be one of the reasons. So we can compare Tesco with Asda, with Morrison, and we'll see what other position, yes. So what is the average coming?
Yeah. What their ratios are in comparison to the like for like stores. Yeah.
Or even we don't need to calculate, we need to interpret. If we'll go Google Finance, yes, and we can get all the ratios. We don't need to even calculate ourselves. Okay, next now, if we look at the next company, Papika, they have 0.65, yeah?
Yeah.
So which is quite big difference if with both company, we assume both from the same sector, yeah?
Yeah.
So is big difference. So we can look around the liquidity there, yes? So Anika is most liquid, yes?
Yeah.
Papika is less liquid. So any question?
No.
Okay, next now, maybe if we look the gearing ratio, gearing mean debt, yes, between the equity. So equities mean the investment, they have 2615, and they have a long-term liabilities which is 4,000, yes. So if we'll go back to financial position ratios, if we look the debt divided by, there are the two formulas. One is a debt divided by equity. So they have 15.59% debt, and they have 84.71, yes, percent is equity figure, yes, which is quite good if we look this one, alternative gearing formula. So they have more equity, less debt. But the problem is equity holder, they expect more return, yes?
Yeah.
If you're a shareholder, you expect. So it's ideally lot of people suggest it need to be 52-53% debt, or more than 50% debt and less than 50% equity. So in that case can be high gear, yes? They are really good in a position if a high ratio is a high risk, but maybe they have to be pay more toward the expense, yes, to equity, because it's very difficult to satisfy the equity shareholder in the long run if they don't pay the dividend. But if we look the other company, Papika, they are totally opposites. 245% they have a debt, yes.
Yeah.
Again, 100% equity. So they are the more risky because they are running business on a lot of one debt. So it's a high risk there compared to the Anika. So we can argue here, and we can look around the industry benchmark. Any question?
No.
Okay, then we can go through other ratios, interest cover ratios, which is how much we can go through trade receivable days and trade payable days. Then we have that's LO and 2.1, that's we discussed. Yeah, we can interpret the information, and then we have a merit criteria, make recommendation. So what you do, can you make the recommendation which company you will invest? That will look based on the profitability.
Based upon the profitability, yes. On that, using those ratios, you could you would choose Papica based upon profitability, but not necessarily choose them based upon other ratios or other mechanisms.
Yeah. So if we look next now, gearing ratio. So according to gearing, Anika is quite good, yes?
Yes, it's low.
So low gear, low risk, yes?
Yeah.
Then we look next now, interest cover ratios. Anika is a better because 11.6 times, yes?
Yeah.
Because they borrow less, they have a less interest to pay.
Yeah.
And then asset test ratios is also Anika is better, yes? So we can, according to overall, maybe we can suggest Anika is a better, yes? Accept the profitability, but we need to look around what is the cash position of Anika, yes?
Yeah.
Because maybe the cash position of Anika. So we can go back to, we can look around the cash position of Anika. So if we go through the cash and cash equivalent, you will see there, Anika's cash is 787, yes?
Yes.
And Papica cash position is 0.
Yeah.
So Papica is more risky in a way, yes? They have no sales, maybe they have all credit sales, yes? There is no money.
No money. No.
Another is, if we look the Anika, they have a lot of retained profit.
Mm-hmm.
Even this year they don't earn, they have still money there. And Papica is very little, yes? Maybe hardly they meet this year's expenditure.
Yep.
So we suggest based on this, Anika is a better, even is a less return, but is a less risky.
Yeah.
So we can make the conclusion based on this that Anika is a better than Papica. So then maybe we can look around which category we are. Is the investor, we are lenders, and what are really we looking? Yes.
Mm-hmm.
They need information and they can make the decision different. Okay. Any question there?
No.
Okay. Then this is being assess the limitation. What is meant by limitation of ratio? We can draw the conclusion. Yes, gross profit better in Papica, operating profit is better in Papica, gearing ratio is better and less risky is Anika, yes, and then we can make the decision. But this is decision, it can't be just based on this. We need to look around other factors, like we discussed political, yes, economics and social, what is towards these companies.
So these factors are affect them in the future moving forward.
Yes, because we're looking for future return. Yes.
Yeah.
So that's why it's quite crucial. And other, we need to look around the limitation because merit and distinction recommendation is quite crucial. What is meant by limitation? Financial statement maybe several months out. Our year finish in January and we are in March. Some companies year finish in December or October, and we have October, and now we are in March. Yes.
Mm-hmm.
Or even end of March. So we need to think about is the 5 months gone, and those are the 5 months old figure, because in some industries even a 30 days can be a lot. Yes, the information can be outdated. Financial statement only include the information which can be made the money term. Maybe we're not looking the customer satisfaction, we're not looking the reputation, we're not looking the legal cases against them. Yes.
Mm-hmm.
Maybe different accounting policies, maybe different marketing strategies, maybe effect of the size of the market and the product of the market in the market. Yes, the size of product line we need to, and ratio may not always be calculated according to the same formula. Yes, can be different formulas even, and ratio analysis may be based on the limited information. So these are the limitations. Yes. And other, if you're dealing with the foreign currency and you're looking the information, when you bring the money back in, so like pound and dollars, yes, which currencies we are doing. And if we don't have a hedging. Do we know the hedging?
Yeah, I understand the principle. Yeah.
Yes, so it's all about the foreign currency. Yes, it's fluctuation, and we don't have a hedge, and we not hedge it.
We've used hedging. We've bought equipment or plant from Europe. So to hedge against currency fluctuations, we've bought foreign currency at the point of sale, so that it can go either way, but at least you've secured or hedged against changes or in direction.
Yes, of course. We are protected against the risk, fluctuation through bank. So we can look around these all, So these are the limitations, and maybe we can look around. Now is a new CEO, yes, and they have a different strategy. And CEO background is army background. I suppose used to work in army man, yes. So maybe strong, very focused approach. Maybe sometime in the real world won't work it.
Yeah.
So we need to look around all these, and then we can draw the conclusion, and then we can say, oh yes, and make the decision or not. So these are all the limitations. I'll send you a separate document for limitation to read when we'll prepare our assignments. Those will help us as well. Huh?
Thank you.
Any question?
No, I find this topic a lot more interesting than marketing.
Brilliant. So if any questions, so today lesson, everyone will learn about ratios, how we can interpret them, how we can make decisions. So there will be 2 documents, all the questions. If you want to do extra questions, the ratios, a good few tasks, and then the conclusion, and based on is a lot of, please go through once, and hope so will help you. If you have any question, drop me email, and I'll try my best to get back to you as soon as possible.
Thank you.
And that's all today, and the next lesson we'll go through our LO3. LO3 will be our last learning outcome, and in between, if you have any question, drop me email. Thanks for your time.
If there's anything you can send me for strategic marketing,